When people ask me what books shaped how I view the markets, John Murphy's technical analysis of the financial markets is always near the top of the list. It's not light reading, but it's one of those rare books that reshape the way I think about cycles, risk, and human behavior in markets. I've gone back through it multiple times, building my own personal index and insights and lessons. And each time it reinforces principles we use every single day in managing portfolios. One of the biggest takeaways is technical analysis isn't about fancy charts or predicting the next tick. It's about psychology. Charts are just the visual record of human behavior: fear, greed, hope, hesitation, all mapped in price and volume. Long before behavioral finance was coined, technicals were showing us what happened when people crowd into trades, panic at lows, or chase momentum. That realization shaped how I view client portfolios. We don't just look at fundamentals, we measure the pulse of the crowd and the behavioral forces underneath the surface. Another major principle is that markets move in cycles. They're not linear, they're rhythmic. Murphy's book drilled home the idea that history doesn't repeat exactly, but it rhymes. Recognizing those repeating structures, whether in moving averages, market breadth, or relative strength, help us adapt rather than react. This is why in our process, we don't just ask, what is happening now? We ask, what part of the cycle are we in, and how does that shape our risk posture? That framework helps us decide when to stay on offense and when to get defensive. One of the notes I pulled from the book was importance of confirmation. A single signal, say one moving average cross or one RSI level, isn't enough. But when multiple indicators across multiple time frames start to align, that's where conviction starts to build. In portfolios, this translates to discipline. We don't act on noise. We wait for structure, for confluence, for confirmation. That's what separates chasing headlines from managing risk with purpose. This is why in our framework, we track not just the indexes, but what's happening underneath. Advanced decline lines, sector participation, volume confirmation. It's not to predict the top, but to identify when the train is losing cars. That's when discipline matters most. Probably the single most valuable lesson is that technical analysis is just the quantitative mapping of human behavior. Technical analysis is not about predicting the future. It's about recognizing repeating structures and adapting with discipline. When I look back at technical analysis of the financial markets, it didn't just teach me indicators. It taught me a discipline. It showed me that growth as an investor comes from refined strategies, reinforcing fundamentals, and staying relentlessly curious. And that's the same mindset we bring to client portfolios every single day. Disciplined, adaptive, and aware that behind every chart, there's a human behavior.